There are two ways to invest in the stock market. One is to study companies, pick the winners, and try to beat everyone else. The other is to quietly buy a tiny slice of basically all of them and get on with your life. The surprising part? For most ordinary investors, the lazy-sounding second option tends to win. Let's unpack why. Start with the simpler option, an index fund. Instead of betting on individual companies, it buys the whole market in one go. A global index fund, for example, holds thousands of companies across the world, in the proportions they exist in the market. You're not guessing who the next winner is, you own a sliver of all of them. If one company collapses, it's a rounding error. And because nobody's being paid to handpick stocks, the fees are tiny. Now, picking individual stocks. It feels smart, and occasionally it's thrilling. The problem is the odds. To beat the market, you have to consistently know something the millions of other investors, including full-time professionals with armies of analysts, don't. And here's the uncomfortable evidence: over long periods, the large majority of professional fund managers fail to beat a simple index. If the pros mostly can't, the honest question is whether picking stocks in your spare time will. For most people, it's a hobby that quietly costs money. There's a second, quieter reason the index wins: cost. Picking stocks, or paying someone to, usually means higher fees and more trading. And fees compound against you exactly the way returns compound for you. A fund charging 1.5% a year versus a fund charging 0.2 doesn't sound like much. But over 30 years, that gap can quietly eat a huge chunk of your final pot. You can't control the market, but you can control your costs, and costs are one of the few things that reliably predict results. To be fair, let's be honest about the catch. Index investing isn't magic, and it isn't risk-free. When the whole market falls, your fund falls with it. You will have scary years. The strategy only works if you stay invested through them. And some people genuinely enjoy researching companies. If that's you, a sensible approach is to keep the vast majority of your money in low-cost index funds, and play with only a small slice you can afford to lose. Enjoy the hobby, don't bet your future on it. So, the takeaway for a normal person who'd rather live their life than watch share prices: own the whole market through a low-cost global index fund, keep your fees low, invest regularly, and stay in your seat for the long haul. It's not exciting, and that's the feature, not the bug. The boring path is the one that quietly wins. If this series has been useful, a quick like genuinely helps the channel, and subscribe so you don't miss the next one. And if you're new here, start with the first video on the snowball, to see how all this compounds over time. And next up, the free money most people leave on the table, your workplace pension, and how to actually claim it. Don't miss it.